Ganeshram Jayaraman is joining us from Spark Capital from Chennai. Ganeshram, good afternoon. Thank you so much for your time. I was looking at some of the portfolio positions in your model portfolio. Let's start by understanding your thoughts on the capital goods space. If indeed we are in a capex cycle, this particular sector cannot be far behind. What is your positioning there, deep cyclicals? How are you addressing this side?
Good afternoon, Ajay. Good speaking to you. Yes, after almost 10 years, about 3 months back, maybe 4 months back, we started seeing the first signs of revival in capital expenditure. It's still, we are about 6 months early in this whole expectation. We think it's more of fiscal 23 and 24 when it will play out, but we think it's good to preempt it because it's a capex cycle after almost 10 years. So there is lot of earnings upgrade potential that we see. A lot of these companies have seen almost anemic, negligible growth over the last 10 years, top line growth. Margins have halved, asset turns have almost halved again, and return on capital and return on equities have literally gone to single digit. So we think we see various reasons why many of these things should improve. It's not a shorter term call, though markets are pricing in everything early, but we think it will play out over the next maybe about in the medium term, 18 to 24 months is when this whole thing should play out. But we are seeing a lot of confidence. So we have gone overweight on industrials as an overall sector. There are various subsectors which are there: industrial consumables, capital goods companies, construction companies. There are even the the real estate proxies, building materials, housing finance. So when I'm looking at capex, I'm looking at pretty much the entire basket, which is household capital expenditure into real estate, industrial or corporate capex, in both in core sectors like cement, steel, renewables, or oil and gas, and also all the PLI related capital expenditure which we should see. We are also seeing it in the global context. Exports, after again almost 10 years, we are seeing engineering exports begin to pick up even in the June quarter. Even recent data is pointing out that exports is picking up. Needless to say, March quarter was very good. But clearly, the one big change in our whole model portfolio over the last maybe 4 or 5 months has been the capital expenditure. I don't want to exclude the government's infrastructure spend, the capex there as well as another important driver. So they all these, and we think there is a very good investment theme emerging there, which is making us feel excited.
Right, Ganeshram. Let's scratch that point of exports a little more. I mean, just yesterday, just a couple of days back, we had Gokuldas Exports, which was saying that they feel the need for raising their capacity, and so was some other company, SP Apparels, on the garment side. When we speak to auto ancillary companies or engineering exporting companies, RK Forgings of the world, Mindas of the world, we get the same. In fact, Raymond was also saying that their orders are going up. Every category of export is witnessing very good growth. In your eyes, do you think it is structural, and how would you like to play this manufacturing? Chemical export is going up. So what kind of a basket would you make of these exporters?
It is cyclical. It is not structural. But the cycles can be even 3 years long. So we need to, whether it will be 1 year, whether it will be 3 years, we don't know. But what we can more reasonably say is there is an upcycle, and that is something that will necessarily make us want to be a part of it. We think it could last 3 years. That is how we are approaching it, based on the capacity utilizations, the likely drivers. We watch a whole host of data, and that gives us confidence that this can be a 3-year cycle. But there can be many pitfalls along the route. As of now, we are looking at it as a 3 year cycle. So it's going to be cyclical, not a structural buy and hold kind of theme. It's but it can be long enough for, and coming off such a long period of down cycle, there could be very healthy returns to be made here in all these segments as well.
Right. Let's take a step back, Ganeshram. Historically, I've really enjoyed chatting with you on your broad calls as well, on earnings cycle as well, on flows, institutional flows, because you interact with some of the best names in the industry. Flows appear healthy. What are your both sides of your client group, FII, DI, saying? What is the sense you're gathering? And even on the earnings front, 12 to 24 months far out, how much of that earnings growth which we are talking about is already in the price?
See, when it comes to earnings, we need to look at two things. One is, what is the likely growth driver, that is demand driver. The liquidity in the banking system. When I mean liquidity in the banking system, I'm looking at bank balances accumulating the savings and current account. That's one. The second is the excess statutory liquidity reserve requirements, which are more than mandated requirement what banks are having. That is primarily our source of demand comfort likely to come. The system is sitting on excess liquidity, which is today's savings is tomorrow's consumption and day after tomorrow's investment. So that is our primary source of demand comfort. From an earnings perspective, obviously top line matters a lot, possibly most important. But another important driver is the industry consolidation which has happened over the last 3 to 4 years in about 20 different subsegments. Telecom, it could be aviation, it could be real estate, in cement, steel, even in power, actually, general insurance. I mean, I can name 20 subsegments as well. We have seen the top few players disproportionately gain market share within the organized, and then from unorganized, market has also shifted to organized. Now, what this does, it gives pricing power when inflation rises, when commodity price inflation comes in, which is what's happening today. You will see companies take pricing action. Now, commodities will go up 50% in last 12 months. Companies can't take such a strong price hike, in conjunction, but they will take it piecemeal. They don't want to hurt demand. Demand is fledgling. So they will take action. Like how we are seeing car companies now take their fourth price hike, in the last literally 6 to 9 months. They've taken 4 price hikes. So they will gradually take price hikes. And then when commodity prices come off a bit, you will see the companies not taking price cuts. That's when margins expand. So what you will see is a combination of top line recovery and earnings drivers in the form of price hikes. And when those two happen, top line growth is strong. Operating costs don't grow as much because it's already coming off a pretty reasonably high base. So top line grows faster than costs, leading to earnings growth being what we think it could be, take the shape of a pyramid. That's how we look at it. It's a pyramid shaped, kind of an earnings growth and deleveraging, lower interest rates. All these kind of help the overall earnings trajectory. So our confidence in earnings is obviously strong enough, and again that will take next 12, 18, 24 months. It is only when that confidence comes that managements will indeed go on to increase capacities.
All right, Ganeshram, we'll let you go on that one. Thanks so much for joining us with your thoughts on parts of the market. Take a small